All right, we need to talk about insurance, but forget what you think you know about rising prices or confusing policies. Something way more fundamental is breaking, and it's creating this crisis that could honestly leave millions of people with nothing. So let's get right into it. In some parts of the world, a safety net that we've all relied on for centuries well, it's starting to completely unravel. For years, the big story was always about how insurance was getting more and more expensive. But that's not the real problem anymore. It's that for a growing number of people in these high-risk areas, insurance is simply unavailable. You just can't buy it at any price. And when we say unavailable, this isn't some temporary glitch. We're talking about major household name insurance companies packing their bags and leaving entire states like Florida and California. They're just not renewing thousands of policies, creating what people are calling insurance deserts. And that points to a really deep structural problem. So, to really get why this is happening, we've got to go back to basics. Like, what even is insurance? And more importantly, how is its core formula just completely falling apart? At its heart, insurance is a pretty simple and kind of an elegant idea, right? It's all about sharing risk. My small, certain payment, that's my premium, protects me from a huge, uncertain loss, all because my risk is pooled together with millions of other people across tons of different places over long periods of time. The entire business model is built for one type of risk, the kind that's random, spread out, and predictable. But in places like coastal Florida, the risk is becoming the exact opposite. It's repetitive, it's super localized, and it's incredibly severe. I mean, just think about the same areas getting hammered by hurricanes year after year after year. And when risk gets concentrated like that, well, the math just doesn't work anymore. You can't spread the losses around, and the entire model just breaks down. But here's the thing. It's not just one thing going wrong. The whole reason for this breakdown is that the industry is getting hit from multiple directions, all at the same time. It's basically fighting a war on four fronts. Which, of course, leads to the question you're probably asking right now. What exactly is it that's breaking this formula so dramatically? It is a perfect storm. First, you've got extreme weather making disasters more frequent and way more severe. Second, the cost to actually rebuild after one of those disasters has just skyrocketed. Third, the global companies that insure the insurers, they're called reinsurers, they're getting nervous and pulling back. And finally, you have these complex legal and regulatory systems that are adding their own kind of pressure. Now, the most logical question anyone asks is, okay, hold on. If the risk is going up, why don't the insurers just raise their prices to match it? It seems like a simple solution, but it is not that easy. In a lot of these places, insurers literally can't charge what they need to cover this new level of risk. State regulators put caps on how much they can raise rates. There's immense political pressure to keep insurance affordable, and getting a rate hike approved can take years. By the time it finally goes through, the risk is already jumped up again. So when you see a company pull out of a state, it's not an emotional decision. It's not personal. It is just math. If the money they're allowed to collect in premiums is lower than the losses they expect to pay out, the only rational business decision is to leave. And this triggers a global domino effect because of something called reinsurance. Just think of it as insurance for insurance companies. So when these massive global reinsurers decide a place like Florida is just too risky, they stop backing the local insurers there. And suddenly, those smaller companies are completely exposed. One bad hurricane season could wipe them out entirely. So their only option is to retreat from the market too. So what happens when the private market just gives up and leaves? I mean, the need for insurance doesn't just go away. So a new and very different reality starts to take its place. A vacuum is created, and the government is pretty much forced to step in. You get these state-backed plans, often called insurers of last resort, and they have to take on all the policies the private market won't touch. But these aren't really solutions. They're more like temporary pressure valves. And the trade-off here is pretty significant. The coverage from these state-backed plans is almost always worse. We're talking thinner, bare-bones coverage that's often more expensive, and it comes with way more restrictions. In short, you're getting a degraded product. So this means insurance doesn't just disappear overnight. It degrades. It becomes this weaker, less reliable version of its former self, leaving people with a lot more risk than they probably even realize. And this leads us to maybe the most powerful idea in this whole explainer. When you see markets breaking down like this, it's tempting to think the insurance industry is failing. But there's another way to look at it. What if the industry is doing exactly what it's designed to do? What if it's sending a clear, brutally honest signal about risk? And that signal poses a really profound question. What do we do when a risk becomes so big, so concentrated, that it can no longer be shared? That's the uncomfortable reality these collapsing markets are forcing all of us to confront. Thanks for joining us.